Lees, who we'd like to welcome back to our show. That's Rob Lees from Mortgage Choice Blue Mountains in Penrith with our weekly finance segment. And today, Rob, we're going to talk about the year that's been and what we can expect for 2015.
That's right.
So, Rob, there are three things you want to comment on, the first being interest rates.
Yeah, well, interest rates, there hasn't been a lot of action on interest rate, well, not on variable interest rates in the last 12 months because they've stayed exactly the same for the last 16 months. Although there's been a bit of movement downwards in the fixed rates. So there's been very good options available in terms of the fixed rates. And I find it really hard to imagine any more rate cuts, but there's some pretty big names at the moment that are talking about even up to 2 interest rate cuts in the next 12 months. Yeah, you wouldn't have seen Diane's reaction there. The listeners wouldn't have seen that. She's shocked.
I was shocked as well. Absolutely.
I didn't see any reaction from you, Vin.
I was shocked on the inside.
So it seems, I think I've got to go with some of these names here. I think there's a very good chance of rate cuts next year. And some of these names are Andrew Wilson from the Domain Group, Stephen Koukoulas from Market Economics, and David Scutt from Scutt & Partners. Now, they've been joined by Bill Evans from Westpac. These are big names. Shane Oliver, who's the chief economist at AMP, I've got huge respect for him. If Shane is predicting it, I think there's a pretty good chance that we're going to get these rate cuts.
And these are what, variable and or fixed?
Yes. We're talking really about variable and fixed operates on a different sort of basis. And the other name is 007, James Bond from Financial Services Council, not really 007. And another one is also Scott Pape from the Barefoot Investor. So they're all predicting rate cuts, and they're saying that it's going to be the first 0.25% round about February or March, followed by perhaps a second one a month or two after that.
So what are they sort of predicting it's going to average in the marketplace?
Yeah, well, it could come down all up by another 0.5%, and the reasons for it is that the Reserve Bank is concerned that commodity prices have fallen too quickly. The Australian dollar hasn't fallen low enough, and the non-mining sectors of the economy aren't growing fast enough. So GB, gross domestic product, only grew 0.3% in the third quarter of 2014. So all those are concerns, and it may very well be that the Reserve Bank has to stimulate the economy a little more, and we might get some rate cuts. And we'll see what happens to fixed rates from there.
All right, so some interest rate cuts to look forward to. All right, Rob, so what about the Australian housing market in the year that's gone by? What do you see for, or what do you foresee?
For 2015, something like that. What do you see for?
Yes, what do you see? It stops you bumping into things, doesn't it? Yeah.
Well, it's been an interesting year, and I think we all should have smiles on our faces because our properties, I think for all listeners, if we are property owners, our properties will have gained value over the last 12 months. The market's had substantial momentum, and dwelling values are 8.5% higher than it was a year ago across all the capital cities. Now, all the capital cities are very different markets, and some have done better than others. But there's no doubt that the growth is slowing. The annual rate of capital gain peaked in April of this year. So that's year-on-year capital growth at 11.5%. So it's slowed down. We're still growing, but it's slowed down from that point. Prices are still rising at a healthy rate. And softening, though, in capital cities like Perth, Darwin and Canberra. The big standouts have been Sydney and Melbourne that have had massive capital gains. But, of course, as I said, it is slowing. What's interesting, I think, for us, I guess, living in a regional area, is they're starting to say that, or this is RP Data, Cameron Kuchar from RP Data is saying regionally we're expecting lifestyle markets to continue their bounce back in buyer demand. So I think that would be us. We're lifestyle markets. It's a little bit out of the capital cities, regional areas, probably seaside places that haven't had a lot of growth. We're probably at the beginning of a lot of that growth cycle. A lot of property buyers from Sydney are coming out this way, particularly into Penrith and the Blue Mountains, because it's becoming a lot more affordable, and so that's predicted to continue in the year ahead.
Rob, any sense of hotspots in the mountains in terms of capital growth 2015? Any thoughts about that, particular villages, towns?
I'm not really a real estate agent. So I really don't have any particular opinion. It's interesting because it sometimes catches you by surprise. Like, for example, where I live at Blaxland actually has done very, very well. And normally the big growth areas or the big price areas are Glenbrook and Lura. So it's kind of like they reached a peak, and then all the other towns and villages are starting to catch up.
Yeah, you posted something on Facebook the other day, I think, about this, didn't you? With some info from RP Data, and I think Katoomba was mentioned in there as well.
Yeah, Katoomba's doing very well.
And look, for our listeners who are on Facebook and who are not yet following you,
they
just
should
go
follow me.
And they should be.
Absolutely. So just go onto Facebook and do a search for Mortgage Choice Blue Mountains. Is it under Mortgage Choice Blue Mountains or under your name, Rob?
It should be under Mortgage Choice Blue Mountains.
Mortgage Choice Blue Mountains.
Blue Mountains in Penrith.
And do the friend request thing, and if if Rob likes the look of your friend request, you'll be in.
Oh yeah.
But you do post a lot of useful information.
Yeah, there's some good blogs that we're regularly writing, so there's some great information there if you need that. Yeah. The other one is that you could expect perhaps a bit of a drop-off in the mining towns because the commodity prices are going down. The prediction is that some of those towns that have been driven by the mining growth are probably going to lose some ground in the year ahead as well.
Right.
Yeah, mining towns are interesting places. I remember years ago when I was on tour with a show, and we went to, I can't remember the name of the town actually. It was in the middle of the sticks, but it was everybody there. The whole town was built for the mining industry and for the people who ran that industry. But a loaf of bread was like $12.
Wow.
Everything had to be trucked in specially, but it didn't matter to those who lived there because they were earning the sort of wages that $12 loaf of bread was no big drama.
Yeah. Well, a lot of those towns have seen massive growth because of the mining boom, but now and people have bought into those areas, and even though there was warnings, and now it's starting to lose a lot of momentum.
All right, let's just have a little music. Here's Dido with Life for Rent.
I haven't ever really found a place that I call home. There's nothing I have is truly mine.
Dido, Life for Rent. And we're back with Rob Lees on the Business Show 89.1. It's just about 12 minutes to 1. Rob, what about the future of limited recourse borrowing, that's a very technical term, limited recourse borrowing, within self-managed super funds?
I guess it just means, as many of us are aware, a lot of people are buying properties now within self-managed super funds. We've talked about that, and it looks like it's going to come to an end. So there's been a huge amount of business that's gone through in terms of buying property through super and having a loan. So the nature of that loan is it's called limited recourse borrowing. So there's a limited recourse available to the lender if the customer defaults on the loan. However, having said that, most of the lenders require personal guarantees from the owners of that fund anyway, so it isn't really that limited recourse. But there always was a general prohibition against direct borrowing by a superannuation fund, and then they actually created an exemption by creating a particular structure, which we won't get into. And the latest, and a lot of us have heard about David Murray's review into the financial system. He's recommending that exemption be removed, which means that if that goes ahead, we won't be allowed to borrow to buy property within superannuation. Whether that'll happen or not, it may be that it's sort of tweaked. I don't really know. I don't think I'd like to see it go. I think it's a good arrangement. However, I think there's a lot of risks, and this is what Murray's pointed out, and I agree with some of what he says in terms of some of the risks in borrowing within a superannuation fund. That if the property goes down in value, it means that other assets are probably going to be sold to make up the difference. If there's issues with cash flow and all that sort of thing, a lot of the time people are putting a lot of their superannuation investments into property and not diversifying. So some of those concerns are warranted. But I think, if anything, I'd prefer if they were to maybe lower the LVR, the loan to value ratio on borrowing within a superannuation fund. At the moment, you can borrow up to 80% of the property value. Even if they brought that down to 60, I think that'd be a pretty good place to meet, and then it hopefully will keep Mr. Murray happy and allow us as self-managed investors to do what we want to do within our own funds.
So a nice compromise, you think?
I think so, because I mean, in some ways, the whole idea of having a self-managed super fund is so that I can manage it myself,
Exactly,
and do what I would like to do. And if I want to borrow to buy property, particularly for business owners who are wanting to buy their premises, commercial premises, I think it'd be a shame to see that disappear. But maybe even if they just lower the LVR, I think it should address some of those problems, and I hope that they'll see some sense there.
Do you think if they got rid of it altogether, do you think it'd adversely affect the property market?
I don't think it will. No, I think it's only really a small percentage. But the regulators are obviously very concerned about the amount of borrowing in this space, and some of it's at a very high risk too.
Okay. Now, Rob, the Australian Prudential Review Authority, or APRA, and the Australian Securities and Investment Commission, ASIC, have announced an investigation into interest-only loans, high loan-to-value ratios and investor loans in the Australian mortgage market. What's prompted this review, Rob, and what do you expect to be the result?
I guess these are the sorts of things that we're just talking about now that have come out of a very heated property market. So because property's been growing at such a rate, everyone wants to get into property. So we've done that with our self-managed super funds and investors. The investor market has grown incredibly. So I think it's almost half of the loans written at the moment have been investor loans. And so the regulators are really concerned about that. They're concerned about the amount of capital that the banks are keeping in reserve. So they're issues for them. And so the issue then with investor loans is normally they're set up as interest-only loans because we get a tax
Negative
deduction.
gearing.
That's right. We get a tax deduction for our investor loan, and it's better really from a tax perspective to pay down our personal debt first and then pay down the investment debt later. But the regulators are concerned about these loans not decreasing and the risk that not only puts on the banks but on the whole financial services industry. So I think we're going to see some tweaking there. They're going to monitor the banks more closely, and I think what we might see is a lot of pressure to reduce the maximum LVR, loan-to-value ratio. Or that's the loan. The LVR is the percentage of the value of the property that we're able to lend against for an investor loan.
Now, I know this might go against the interests of many who might support potentially the current government, but there's been increasing talk about negative gearing and capital gains. Do you feel is this an investigation which lays the groundwork for the government to perhaps review those two tax issues?
Yeah, I think that's going to be part of the Murray review as well. I don't know whether it will be scrapped totally, but I think there's going to be some changes in that space in 2015. I don't think it's going to be exactly as it is now. I don't think it'll be totally scrapped, but it might even be that the negative aspect of owning an investment property at the moment, the loss on holding that property is offset against your employment income. Okay, it may very well be that they don't allow that to be offset against your employment income. That's possible. That could be one of the changes. But I think they're going to limit. It may very well be that they'll limit. At the moment, you can borrow up to 95% of a property value as an investment property, but they may limit that. One of the changes might be it'll come down to say 90%. But I think they're going to do some tweaking there.
Okay, well, thank you again, Rob. That's Rob Lees from Mortgage Choice Blue Mountains in Penrith, and you can contact them on 4739 9749 or visit their office at 3/13 Hope Street in Blaxland. And Rob, thank you so much for joining us on the show and being a part of the show throughout the year. We're very lucky to have you here. The information that you give out is fantastic, and we actually do get a lot of good feedback about the finance segment on the show as well. So thank you. And you're coming back again next year.
Yes, I've really enjoyed it this year. I find it really, really stimulating. It's difficult in some ways in terms of time, but I really enjoy it, and I'm looking forward to it again in 2015.
Yep, and we're looking forward to having you back on the show in 2015 as well, Rob, and wishing you and your family a very happy Christmas, and hoping that the chap in the red suit does the right thing.
Thank you very much.